In today's video, we're discussing 5 mistakes that Canadians make when they get a mortgage or when they have a mortgage. That's right, this isn't just for the people who are about to get a mortgage, but also those of you who already have one. And we're going to discuss all the mistakes that you should be avoiding, especially with rising rates on the horizon. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. All right, welcome back. Today we're discussing 5 mistakes that Canadians make with their mortgages. And some of these are going to apply to people who are getting brand new mortgages, and some of these are going to apply to absolutely everybody, regardless of whether you are just getting a mortgage or whether you already have one. And we are going to discuss the biggest mistakes that people make because these are big ones, especially with rising interest rates on the horizon. But before we get into all the details, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where we're going to give away $5,000 to one lucky winner. All you have to do is subscribe to the channel and watch for the video that will tell you exactly how to win. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. So let's get into it. Let's discuss the 5 mistakes that Canadians make when they're getting a mortgage. And we're just going to jump right into it today and start first and foremost with number 1, which is not putting the product first. The number 1 mistake that Canadians make when they're getting a mortgage is they go around and they only look for the lowest rate. We see this all the time. People will call us, say, what's your lowest rate? They'll call us and say, here's my scenario. Can you quote me a rate based on that? And quite frankly, the answer to that question is no, because anybody who does quote you a rate based on just the information that's provided over the phone is probably just taking a guess at it, and the chances of them being right are slim to none. And on top of that, it totally dismisses all the important things that go along with the mortgage, which are the product and the features. Because for some people, you're going to want to have something like a Scotia Step mortgage that has a readvanceable line of credit that opens up a line of credit as you pay down your principal. And that could protect you in the event of higher interest rates, or if you want to use that money for investments, or if you just want to have it for a rainy day fund. Or you may want to have a mortgage that can be transferred to a different lender at some point, because maybe you can get a lower price, or maybe there's some future thing that is going to happen that you want to be able to basically get away from the lender that you're at and move to another one. A common scenario where this could be the case right now is if you have a variable rate mortgage, and if you don't have the flexibility to switch to a different lender, you can basically find yourself in a position where you have to pay whatever that lender tells you if you decide that you want to lock in. And again, higher interest rates could mean locking in. You want to have the flexibility to leave. So there's a whole bunch of things that come along with the product, and the product features should be the first thing you're asking about. And if you're calling a bank and you're calling a broker, the best question you can ask is, what makes this mortgage better than all the rest? And if they answer the rate, well, it's time to move on. When it comes to getting a mortgage, you always want to put the product first, then you want to make sure that you have a mortgage with a favorable penalty calculation, and then you ask about the price, because the product and the penalty calculation should come first. And then once you have the mortgage that meets those criteria, then you can go and start comparing prices of comparable apples to apples mortgages, and then you choose the one with the lowest rate from there. Now, the second mistake we see Canadians making quite often is thinking a 5-year fixed is safer than a variable rate mortgage or an adjustable rate mortgage. And the reality here is it just isn't true. A 5-year fixed mortgage is a 5-year adjustable mortgage. The rate will adjust every 5 years, and therefore you have to take that into consideration when you are choosing a 5-year fixed rate mortgage. The other thing you have to keep in mind is you typically pay a premium for a fixed rate mortgage over a variable rate mortgage up front. And you also pay a premium to get out of it in the form of a penalty. Remember when we just talked about penalty calculations? Well, this is a big place where it comes into play. And the worst offenders when it comes to big 5-year fixed penalties are the big banks. So we very rarely ever place clients at big banks anymore with 5-year fixed mortgages. Most of our big bank clients nowadays are choosing variable rate mortgages or lines of credit of some sort. And here's the big thing you have to keep in mind. If you think you're safe from rising interest rates, you're not, because at some point your payment is going to adjust. And for a 5-year fixed mortgage holder, it's going to adjust pretty much overnight in 5 years when your mortgage comes up for renewal. So therefore, you can experience what we call payment shock, which is where your payment elevates very, very quickly, pretty much overnight, and you didn't even expect it. So if you have a 5-year fixed mortgage, you need to be making sure you're paying attention to interest rates and have a strategy for higher interest rates, just like a variable or an adjustable rate mortgage holder. That is why I often recommend adjustable rate mortgages to people, because people will then feel the adjusted payments over time rather than all at once when the mortgage comes up for renewal. And by the way, variable rate mortgage holders that have a static payment, you have the same risk as a 5-year fixed mortgage holder. The third mistake we're seeing people make is not being ready for higher interest rates, not having a plan. And what do I mean by a plan? Well, paying attention isn't just enough. You need to have a plan to budget, to lower your expenses, increase your savings. And in a lot of cases, what we're recommending is that you're taking the difference between what the qualifying rate would have been when you got your mortgage, which was probably around 5%, and the payment that you're actually paying, and calculate the difference between those two mortgage payments and take that money and put it away so that if at some point in the future you need to subsidize your payment, you have the cash to do so. Now, some of you may be thinking that's absolutely impossible. I couldn't pay that 40 to 50% higher payment that I qualified at. Well, if you're in a situation where you absolutely couldn't pay that rate, it might be time to start thinking about adjusting the size of your home, maybe buying a different house with a smaller mortgage that's more affordable for you, because inevitably when interest rates do go up, if you are stuck at the same income level, you could find yourself in a world of hurt. The fourth mistake we see people making is not letting a broker shop for your mortgage. Now, here's the thing about a broker is there's good ones and there's bad ones, just like there's good bankers and there's bad bankers. But most mortgage brokers in the country have some sort of obligation to act as a fiduciary for you. In other words, they have to protect your interests, which means they have to understand your interests, your future, what you're going to do 3 to 5 years down the road. Whether or not a mortgage that has a discount rate that has features taken away is the right type of mortgage for you, or whether a big bank mortgage with a 5-year fixed and a massive penalty is something that fits your circumstances, because lo and behold, you may never be selling that property and may never have to face a penalty. By the way, 60% of Canadians don't make it to the end of their first 5-year term, which means almost all of those people will find themselves in a scenario where they have to pay a penalty. So it's important to have somebody who is there to look to the future and pick up on the things that maybe you don't know, or that you don't know that you don't know, and make sure that you're set up with the right lender. And by the way, just because you have your car loan or your banking or your credit cards with a specific lender doesn't necessarily mean that they're the right lender for you. Every single lender, every single bank does certain things really well. Some of them do mortgages exceptionally well, like Scotiabank and First National and MCAP. Some of them don't do mortgages very well. And you know what? The biggest banks in Canada that you think might be the best are often the worst when it comes to your actual mortgage choice. And think of it this way. When you go and get a gym membership, they pretty much take the payment out every single month and everything's fine. A mortgage is the same way. If you end up getting it with a different lender, all that's going to happen is your payment comes out of your normal bank account. You're just dealing with a different company when it comes to your mortgage. And for the most part, most people aren't going to have to deal with their mortgage very often. So does it matter if you have a banker or if you have somebody who is a broker who's taking care of you, or somebody who's on the phone line on the other end of the line at what we call a monoline lender, which is often what we consider to be an A+ lender. So get your mortgage at the place that has the best product for you. Don't worry about the brand, worry about the product, the penalty, and then the price. By the way, if you are shopping for a mortgage and you're dealing with a broker or you're dealing with your bank, and for whatever reason you can't end up with Mortgage 360 to do your mortgage, maybe you're in a different province than we deal in BC, Alberta, Saskatchewan, and Ontario, by the way. Or maybe you've got a brother or a aunt or a sister or a cousin or some family member that works for a bank or works for a broker and you feel obligated to use them. Or maybe you're just so far into the process with a bank or a broker. Well, we have a course that we call Secrets to Getting the Lowest Interest Rate that is designed to give you all the information that you need to do this all yourself. Now, we recommend you do it through us, but if you need to go at it alone, this is the course that gives you all the information to get the absolute lowest interest rate without stepping on any landmines or having any surprises come up in your mortgage 3 to 5 years down the road that you weren't aware of, like a big bank 5-year fixed penalty. That course is priced so reasonably, primarily because my personal why is to inspire people to thrive financially and give. This is my giving piece, and I want to make sure that you're able to thrive by making sure you have all the information you need to get the right mortgage. So we have priced it so reasonably that you should get 10 to 50 times your money back on it easily. And if you end up choosing Mortgage 360 for your mortgage, you just say, hey, I don't want to do all the work. There's a lot to this. Maybe I should hire an expert. Well, we put a special offer in there to make sure that you get at least 10 times your money back. So if you want to get that course, go to ratesecrets.ca. And fifth and last but not least, the biggest mistake that we're seeing people make right now with their mortgages is maxing out the amount of mortgage they can get. In other words, buying at their absolute maximum purchase price. We don't love this for a lot of reasons, but the main reason is because it puts people right up against their capacity to pay. And speaking from experience, back in 2012, my wife and I found this out the hard way when we purchased for the absolute maximum mortgage amount that we could afford. And it was a rough 4 to 5 years trying to make those payments every single single month because they were big. And without even realizing it, we bit off significantly more than we could chew. Now, the good news is after 5 to 6 years, we started to earn significantly more income and those mortgage payments became more reasonable for us. But I can tell you right now that buying at the maximum purchase price that you can buy based on a mortgage qualification is something that can create a lot of stress. So what we recommend quite often to our clients is when you're applying for a mortgage, find out what your maximum mortgage amount would be, and then back that off by about 20%. Give yourself some room to breathe and don't necessarily purchase at that maximum purchase price. So those are the 5 major mistakes that we see Canadians make on their mortgages, and they are the big ones right now. There are many more mistakes. There are many other videos that we can link to and that we can talk about on this channel that talk about the product, the penalty, the price, that talk about variable versus fixed, that talk about the mortgage basics. But for the most part, these are the 5 warnings that I want to make, especially considering we're in that environment where interest rates could be going up. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about that race to 25,000 subscribers, and we'll see you on the very next one. Cheers.